Hello, good evening, everyone. Sat Shri Akal, Namaste. I am Kulbhushan Sharma, and I am shooting this very special video on the occasion of Teachers' Day. So there are many teachers in your life which are teaching you directly, and there are many teachers in your life which are teaching you indirectly. So a very special teacher in my life, which is who is teaching me indirectly since last almost like 2 odd years. I will be trying to do a review of his book, which is launched almost 14 days back. The book's name is Diamonds in the Dust. So this is a very good book by Saurabh Mukherjea, Rakshit Ranjan, and Salil Desai. He is one of the person which I am trying to follow from last 2 years. Probably I have watched all videos and trying to imbibe his investing habits and trying to do the same with my clients as well. So before starting the book, let me take you to a couple of pointers why this book was actually started. So my mission was when I started to teach, or probably apart from what I do normally in my company, when I started to teach, I started teaching about 150, 200 students every odd year. My mission was to educate people about investing into stock market. Why? Because I have seen myself when I was a banker, I was with ICC Bank and IndusInd Bank. I have seen myself people burning their hands in stock market because of probably couple of advisors, or I can probably say bankers which are not properly trained. They try and pitch products to people. They invest into stock market. They burn their hands and they were never to come back. So I want to tell them that stock market is not a place where you burn your hands. It is a place to for wealth creation. This is a place where you should go invest. Forget about next 10 years. If you have bought a very good stock, and the kind of wealth you would be creating would be unparalleled through any kind of parallel asset class. So let me take you why I wanted to talk about this book, Diamond in the Dust. This has been done by Saurabh Mukherjea. So it is started by a foreword by Mr. Sir John K. It says they both share the same belief that successful investment requires a knowledge of business. While people are interested in securities market, not product market, in stocks and not in companies, rather than thinking that people should buy a business that makes goods and services that people would want to buy, people like you and me would want to buy for years to come. Marcellus is founded on the principle that to understand the stock, you must first understand the company and buy it only when you can hold it for 10 years. If you cannot hold it for 10 years, do not even hold it for 10 minutes. So going to the next topic that he has covered in this book, he has said that he has taken an analogy of test cricket and investing, and he has taken Rahul Dravid as a core example. He said before successful investing, to the first you should learn to leave the risky shots, learn to leave the risky shots or probably risky stocks alone, then to identify the ones which can grow earnings and their free cash flow steadily. If you are able to find such stocks, then bet big on them, big on them. Real challenge is to mentally conditioning and discipline to apply those skills and to training consistently. So he then talks about 4 myths in Indian investing. He said most of us worry about emergencies and hoard cash. Then suddenly a sharpshooter, probably an agent like agent from an insurance company or from banker would come along. He would offer his fantastic deals. He would be persistent. He would be pushy, and he would be throwing some Excel sheets, some numbers to you, and he would be powering your fears, emotion, and guilt, and he would be getting your money. This ends in several ways, like losing your entire money, having a partial loss, or a bad investment which is not even able to cover up the inflation rate, or probably rather worse, not even a fixed deposit rate of interest. So for an average Indian household, the statistic says that 84% of the wealth is locked in real estate, 11% in gold, and 5% into financial assets. And out of those 5%, I can surely tell that of those 5%, probably not even say 2 or 3% would be in qualified instrument like mutual funds, or a very good PMS, which normally Marcellus PMS like Marcellus are having. So let me take you to the first myth, which says gold would help me in protecting my wealth. Why he says that gold will be helping in protecting my wealth? Because 11% of us are having their financially having their money spent in, saved in the form of the gold. If you talk about gold, everyone says that probably this is the instrument which would be helping me in protecting my wealth. Let me share you with you his presentation, and it will be a little bit better, right? So as you can see, let me zoom it a little bit. Yes, you can see it now. That probably, if you can see, in the decade of last decade, 2010 to 20, gold has given a return of 9.2%, whereas BSE Sensex has given a rate of 10.4%. So you can see that probably a 1.5 rate of interest, probably because of last decade was very flat for the Nifty and BSE Sensex. Now, if you go back for last 30 years, the kind of wealth that has been created by BSE Sensex is almost 15%, right? And gold almost 9%. There is a gap of 550 basis points. So investing into gold, investing into basic Sensex, Nifty or say BSE Sensex is giving you 550 basis points extra than gold. Here we're not even talking about consistent compounders, which will be giving you somewhere close to 20%, and we will be covering up later stage of the review of the book. Second myth he's talking about is real estate will help me in growing my wealth. So over the period of last 5 years, probably you would have seen that real estate in cities like Delhi, Mumbai has not given you good returns. Probably they have not even beaten inflation rates. The rental yields are very low, 2 to 3%, and home loan rates at the best is close to 7%. So still there is a gap of almost 400 to 450 basis points to cover up between the rental yield and the kind of home loan rates that our country is having. Most of the developed countries are having their rates both very similar. So if you're living on rent or if you're living on a purchased property, the thing matches up, and then probably the investing into real estate there would probably make a little sense, but not here, because real estate here involves high transaction costs. We sometimes are fearing about expense ratio of mutual fund. Say this fund is having an expense ratio of 1.5%, but we do not realize that real estate is having a big transaction cost, almost 6% going towards your stamp duty, almost 1 to 2% going towards broking, and several other charges. So it is almost a 10% transaction cost of purchasing a real estate. So, and also it is not a very liquid instrument. Third, debt fund, mutual fund offer decent returns with low volatility. See, there are 3 risks attached with debt mutual fund, which can actually take your returns to negative zone also. Interest rate change. Say, for example, now, but we are almost at the bottom of interest rate cycle. If you purchase it for next 3-4 years, whereby quite likely it will be taking a U-turn, your returns would be quite likely it will be in the negative zone. Default by a borrower. We all have seen what has happened with Franklin Templeton or some credit risk fund when Vodafone defaulted or ILFS defaulted. There has been risk. If the company stop making your repayment, your principal would be lost. Then for sure, the high rated fund with the better rated instrument, say a fund like IDFC low duration with 100% AAA rated instrument, your return will be very low. Vis-a-vis, if there is a credit risk fund or probably a fund with low rated instrument, the returns would be for sure high. Very simple reason. Say for example, if I'm a Bajaj Finance, a very good rated company, I will not be giving you kind of returns 9 to 10%. I will be only offering you 5.5 or 6% of returns. That is the quality of my company. If I am a BBB rated company, I need to offer you better returns so that you invest with me, right? Myth 4, GDP growth drives the stock market, and hence we can time the market accordingly. It is not at all true. Stock markets are predictors of GDP. GDP growth and they are not reflectors of that. It is a myth that probably GDP is going high and stock market would go also high. Rather than it is inverse. Our stock market is going high. It is as we say that we discount the future values, it is quite predictable that our GDP would also be going up. That is how normally these 4 myths are discussed in this book. Then he discussed about equities are the better way to build wealth. And then he discussed about what are the different kind of risks that we have while investing into equity. First risk he's talk about is accounting risk. He then displays that while we all know how prominent banks first their bad debts for years until RBI asset quality review forced them to come clean. We have seen what has happened with most of the PSU banks. I may not name them, but everybody knows what has happened with most of the big private banks like SBI, PNB, Canara, Bank of Baroda, Indian Overseas. Everybody knows what has happened to their balance sheet. Now the same problem exists with certain housing finance companies as well. Accounts of a leading cement manufacturer, a high-flying retailer, prominent petrochemical company and a pharma company does not stack up. This is a kind of hint that he has given in this book, and probably we should be more careful while investing into certain companies that he has mentioned here. Then he talks about that there is a revenue risk. India's per capita income still is very low compared to our neighboring countries like Sri Lanka, or say China, even as of now, if you consider Bangladesh. So he says that basic essentials like FMCG, medicines, or say financial services product would always be in demand and would always be doing good in long run. Whereas if you are depending on the cycle, probably affluent people, or the categories which require affluent people like auto or real estate, they would be dependent on cycle, and you would be requiring to invest at bottom and exit at peak to get some good return, right? He has given an example of Maruti gives you around 12%, which is a decent return, almost equivalent to GDP. But a stock like which is involved in fast moving consumer goods, Marico, Asian Paints, they are giving you 20% plus return. Third risk he's stating about profit risk. He says, even if you come up with a very good product in countries like India, imitation after the first move is quite rampant. So if you're coming up with a new product, you will very well see bigger companies with deeper pockets would in next 5-10 years would be coming up with a similar product. So we try and invest in companies where the top two dominate for almost 80% plus market share. So we are in a safe zone, and we continue reinvesting our cash flows and giving you good returns. Last one is said liquidity risk, which probably people do not foresee initial hand. That is why probably people say do not invest into penny stocks, right? He says that average daily traded volume of bottom half of Nifty is even less than 10 crores, right? We do not want to be in position that we have invested in a stock and then say after 5 years it has become 5 times, but now there is no buyer. So try and think that it is in an inverse situation. You have purchased stock in 5 years time, it has gone to half of this value. Now you want to at least encash half of the principal that you are left with, and you are still not even able to trade that, right? So these are the 4 risks he's talking about when you're investing into equities. He comes up with the Maslow's formula of consistent compounders. He said there are 3 C's: creditable accounting. He uses certain forensic accounting ratios and techniques to identify companies with the least accounting risk and highest reliability of reported financial statements. And he has given us a certain checklist also, which we will be discussing. He said, second, there should be a competitive advantage. Companies that possess strong and durable pricing power over the period of time enable them to be a leader in their market and consistently earn returns which are higher than the normal market. Third, a very important thing, that is capital allocation, which has to be done in a very correct way. He has given us certain case study whereby the capital allocation was not done correctly in an altogether very different segment, and then the company stopped performing. He then tells you about covers in the book that there are 3 types of stocks: type A, type B, type C. Type A stock, he says 90% of stock giving you almost no earning over a period of say 10 years. So no sustainable competitive advantage they have. So they are not able to generate a ROCE, that is return on capital employed. So over the cost of capital, he has given us example of telecom industry or a airline industry where their volumes are growing, ending every quarter, but they are not able to come up with anything which is having a competitive advantage or growing their earning very high. Type B stocks, which are like very good franchisee like HUL or a Maruti, which have a competitive advantage over peers. Maruti have an advantage over say probably Mahindra or a Tata or a Hyundai, but then they are cyclical stocks. They would be giving you returns similar to GDP. GDP is going down 10-12%. They will be giving you similar returns over a long period of time. Type C stock, he says, consistent compounders with definite competitive advantage, which helps them grow at almost 25% per annum. This is the kind of framework that he has given. Say, for example, you have invested in a company, your fund manager, say from XYZ AMC, he is able to invest in a company which has a decadal earning compounding of 0. There are almost 50% stock in BSE 500 which have given you negative returns also. So it should not be coming to you as a shocker. So decadal earning compounding for a company, for a certain airline sector is 0. They are not able to grow their earning, even if they are able to buy at when their PE is low. And then whenever you sell, that supposedly the PE is almost double. Say, for example, earnings are not growing. say their earning is 10 crores, their price is for example 20. So 20 by 10, and the PE doubles in next 10 years, it becomes 40 by 10. Earnings are almost same, they are not growing. So 40 by 10, they are giving you a return of only 7%. Say for example, converse thing happened, your fund manager was not able to buy the stock at the right time. PE was at 40 when he purchased, and after 10 years, it came down to 20. So you're losing your 7% of capital even after holding it for 10 years. So it is not at all a mantra of buying the stock and then forgetting it. Second kind of stock are Buffett, good franchisee, giving you a compounding of almost close to, say, what your GDP is earning, 10 to 12%. Say, now once again, if the fund manager is able to buy it at low and sell it at high, so for example, they are making 7% from buying low and selling high, and then earning growth at 12%, giving you 19%. And if he mistimes, then he will be giving you 5% over a period of 10 years, which is not good, but at least you are not losing your capital. Last one, consistent compounders, companies like Asian Paints, SGFC Bank, Astral Pipe, Pidilite, they are compounding at 25% every year, right? So buying low, selling high is giving you 32. Even forget it, buying high, selling low, still will give you somewhere around 18%. That is the mantra of consistent compounder, which has been driven by masterless investment managers. So next, he is talking about what to buy and how to check the accounting quality. He is giving you a certain fact that 40% of stocks in BSE 500 have exited the index in next 10 years. And prime drivers of those exits were corporate governance, poor capital allocation. He has given you certain examples. Say, for example, Satyam. Till 2008, everybody was talking about Satyam as next Infosys or TCS or HCL. But in last 5 years, in those last 5 years, it has also grown by a CAGR of 34%. And suddenly, Mr. Raju came up with a ladder of falsification of the accounts, and then he then reported that probably actual cash balance was 320 crores only, and not the 5,500 crores as reported in the book. So finally, what happened? Same day, the stock crashed by 78%, not even giving you enough time to actually come out of the market. Second thing, he says that financial statements from the foundation of investor value, you should value the companies. He says 50% of BSE 500 companies have not been able to generate positive returns, which I covered almost a minute back in this video. So 50% of companies sitting in BSE 500 over a period of 10 years have not even given you positive returns. Just go through this line very slowly. He says that between 2003 and 20, there was a churn rate of 12% in BSE 500. So roughly 60 companies exiting BSE 500 every year. And only 18% of them have given you return of 15%, which most of the people would come and boast that I will be giving you 15% return over a period of 10%. That happens with only 18% of the companies. So some of the super chats which have imploded, we would have heard the names like Suzlon Energy, Lanco Infratech, Educom Solutions. They were thought to be next multi-baggers. And see what has happened right now. They have gone down by 99%, 99%, and 98%. That is kind of wealth erosion by holding the stock for almost 10 years, right? He then given an example of Rico India. Rico India was a subsidiary of Japanese company. They have, but through some acquisition, they acquired some to enter into IT services. And over the next 4 years, they inflated their books from 298 crores to almost 1600 crores. And then in 2015, when the auditor raised the concerns, it was handed over to PwC. Entire management, including the MD, was sent on leave. And then when the actual results came out, it was a loss. They have booked a loss of almost 1100 crores, including a 700 crore adjusted profit for last year. That was the kind of inflated books they have. So talking about, did they have a negative, did they have a red flag beforehand also? Yes, they had. Nobody like retail investor like me, they were not taking their free cash flows. They were free cash flows of almost 220 crores in financial year 2015. So key traits of these fraudulent companies is they're reflecting that probably you should go and check certain traits in the company. He says go and check if promoters have pledged their shareholding. He says you should go and check whether the free cash flow is actually rooted or probably equivalent to the EBITDA that you are having. He has given certain annexure that probably you can go and cover. He has also given you probably off balance sheet liabilities and complex holding structures. Say, for example, I can give you a structure of Cox and King or probably Amtech Auto. They are having so many complex structures. They use sister concern to book intercompany transactions to cover up to probably make their revenues look bigger, but it was just an intercompany transaction. So he has given a very beautiful annexures of certain checklist for forensic ratios as well. He has given income statement checks that you should check cash flow from operation as a percentage of EBITDA. Very, very valid point. He has then told that probably you should be checking yield on cash and cash equivalents, right? So giving you a certain example on this, probably you can take example of DHFL. DHFL was booking a very high treasury income, right? Almost 30% of its NII, that is net interest income, was coming from their treasury income. So what we can get from that, that probably their treasury department is buying and selling not a very good rated instruments and then booking very high percentage of income in for NIE as a function of a treasury income, which is not a very good sign for any financial company or an NBFC. He has given those points while checking when you go for banking and NBFCs also. Then the case study of 1% Beverages, a very good company showing very excellent numbers. And suddenly, when the company's auditor, Deloitte, resigned in between, I guess it was the year 2018, the entire management, they said that they had inflated the numbers. So when the investigation started, it was found that they were taking a fake input credit of almost 300 crores. How? They have created fictitious companies and employees, and then between fictitious companies, the transaction were exchanged and input credit was claimed, and it was in tune of 300 crores. Their revenue was inflated 8 times. And yes, they were once again red flags in their audit, which a normal investors should have gone deep, or probably a fund manager should have gone deep while understanding why this 1% Beverages has gone bankrupt. So these are the certain checklists that which he has given. That he has also stated that any significant portion of company's operation not audited by principal auditor. You have two companies A, B, C, D, E, and then a certain subsidiary is not audited by one of the main companies. So it gives a certain kind of a you should be checking it. Then he has covered that probably pledging of promoters shareholding, quality of audit committee, and are there a frequent changing in accounting periods? Yes, we have seen in certain very big companies that the accounting periods are getting changed every year. So Cox and King was a classic example of capital misallocation. They started buying too many companies, and they started using related party transaction with EasyGo as one of its tools to inflate the number and the siphon of the money. A very, very detailed study he has given for Cox and King and Amtech Auto as well. He said between the period of almost 15 years, 2000 to 2015, they have acquired 15 companies, which probably in their peer segment of auto industry, nobody was doing so many inorganic purchases. But then when they started purchasing them, not through their free cash flows, but by getting it financed, their revenues jumped 30 times. The big part was that even I guess 1 year before the bankruptcy, Amtech Auto was still in the process of acquiring certain companies. So another red flag that this company was showing, that red flag, negative free cash flows for almost 13 years in between, and nobody was checking that. Negative free cash flows for all these years continuously. Amtech Auto went bankrupt, and we once again failed to identify that. He then said how to spot the naughty lenders. Naughty lenders as in NBFC companies or banking. He has given certain example, like you should be checking the treasury income as percentage of net income. We have covered this point in DHFL. Fee income as percentage of NI. Say for example, I'm trying to give you a loan, but I will be asking you that I need 3% of upfront income so that I can book that income into my PL account. I can show to my investors in my quarterly income that I have very good fee income, not realizing that this income is disproportionately high. Say for example, a bank A is giving you a loan at processing fee of 0.5%. Citibank give at almost 10 paisa, and there is an NBFC which is giving you lending you at say booking a fee income or income taking at 5%. There are certain NBFCs which have been doing this continuously. He is saying that probably NPA volatility should also be seen. There are banks which are able to control. There are certain periods, like say talking about last 2 years, there would be increasing number of NPS, but it should be in control. It should not be like in first quarter it is like 2%, next quarter 7%, next quarter 3%, then again 6%. So volatility is a very key measure of looking into that. Provisioning is also a very important parameter when you look into NBFCs or banks. Next, he comes down that how do we buy some great franchisee? We have discussed that these are the things which have been going wrong with MTech Auto, 1% Beverages, Cox and King, and certain other DHFL, certain other companies as well. Beautiful case studies given in the book. He then tells you how do you buy great companies. He says that ideal business is one which earns higher return on the capital, could generate a lot of free cash flows, and invest all those once again into company to generate more cash. That is when the company becomes a compounding machine. It should be having a competitive advantage. He says that firms with strong and sustainable competitive advantage can sustain their ROCE, that is return on capital employed, substantially higher than the cost of capital over a long period of time. Say, for example, he says that Page Industry, the owner of the licensee holder of Jockey and Speedo in India, is having a pre-tax ROCE of 60, while his competitors, Rupa, Dollar, VIP, is having somewhere close to 23, 17, and 6. That is the power of this company called Page Industry. It has been a multi-bagger over the last so many years. Maruti is having 22, Tata is having 13. So very clear example why there are certain great companies and having a competitive advantage. He said there are three types of advantage that probably companies could have: supply advantage, demand competitive advantage. It can also be having economies of scale. And then he says that, Sir John says that there are three parameters on which the company develops the competitive advantages: innovation, brand, and architecture. And it should all be having strategic access. Talking into innovation, he says that successful innovation quickly attracts imitation, as I already covered in this video before. So he tells about what are the innovations that the powerful companies have developed. Asian Paint was the first company to get mainframes in India in 1970, even before government of India. Then it got the color computer to reduce its printing time from 5 days to 5 hours. He now uses GPS into good carrying trucks. This is the kind of innovation that big companies are bringing in. SDFC Bank gave a solution to all kind of capital market players. He brought them together, and a large chunk of capital market came together only with SDFC Bank. That is kind of its monopoly it was developing in those days. Then he also talks about, gives example of Garwari Technical Wear, whereby it is a very not a very big company, very niche product of fishing net, and it has developed certain kind of fishing nets with patented copper solution, and it is not giving you getting rid of the major problem of breaking of nets, repair of nets, and then sea lice problem. They have actually patented those things, fouling, strength, and then it has also now gone on to different segments as well. So company is developing its patents, its R&D, and then going to next level. He then said that the brand also plays a huge part. He says that brand also need to continuously evolve with the changing aspiration. We have seen companies like Titan watches, VIP Fancy, Bata Footwear lost its credibility over the period of time, having not changed with time. Similarly, Page Industry, Jockey have been coming up with new set of branding every 5 years. SGST, AMC, strong company. Page Industry, strong company. They have overcome challenge of brand dilution successfully over the last period of 25 years. He says architecture is a system of relationships within a firm or between the firm and its suppliers. It should be very strong. That is why he says that most of the Japanese firms have certain advantages over the American rivals. He says he has specifically given an example of TCS, where all CEOs are grown within the company. Now, when say Mr. X becomes CEO of TCS, he already has experience of almost like 20 years of working in this company. He knows this company inside out. So he will not be taking a lag of say 6, 10, 18 months to smoothen the company operations. He is already a part of TCS. That's how they develop the companies. Pidilite, with one of the largest range of distribution networks from a mom and pop store to pawn shop to a carpenter, everywhere they are using Pidilite products. And through that knowledge only, they come up with different kind of products like Heatex, Speedex. They were all given as a part of feedback from the carpenters, right? This is the kind of strategic asset that the company has, right? So coming next, what are the common policies about the competitive advantage, pricing power, and importance? He says that airline industry, talking about Indigo, he says that it has grown from 15% market share to 50% market share in last 10 years. But its revenue per passenger has increased by only ₹1. Why? Because this industry is like that. Say, for example, I'm traveling to Mumbai tomorrow and Indigo is giving me a rate of 2000, where a different airline is giving me 1800. I would be choosing that. I have no brand loyalty to anyone. I will be choosing a different airline. So that is why you can actually increase your market share just by decreasing your price. Decreasing your price, decreasing your earning. So there is no competitive advantage is that. Airtel was having almost 40% of market share. And as soon as Jio comes in with predatory pricing, almost zero price, then it started receding its share. So branding has to be looked into very carefully. So what are the frameworks to identify dominant firms in India that have sustained high pricing power? He says each and every monopoly is different, and they become different because they have solved different problems. He says that companies like Polaroid, Kodak, or Xerox, they have failed. Why they have failed? Because they failed to come up with the challenges that was coming in the future. Disruption of product service due to technology. That is the kind of proactiveness that the company should have before moving to the next level. He then discussed a very beautiful, very detailed case study of DVs. Why DVs is good? DVs is having almost 50% of global share of couple of naproxen and dextromethorphan APIs. Why? Because it has two important things. It is 100% IP compliant and a non-competing service provider, which has won the trust of all major companies which DVs work with. Say, I am a bigger company, you are manufacturing it for me. Major concern for me would be that probably tomorrow you would be using this IP and coming up with your own product. This is where DVs say that I am not going to enter into your market. I will be only manufacturing it for you. So you should be very comfortable in sharing your IP with me. That's why DVs has been growing every year. Revenue growth by 90%, PAT 15%, ROCE of 30% year on year. What else you should ask for a company? He says they're master of capital allocation. That two companies with different with identical operating results and different approaches to capital allocation would be giving entirely different outcomes for the shareholder. So your capital allocation should be very, very good. This is a very good, a very simple diagram that he has given, that you build a strong competitive advantage, you earn a higher ROCE, you generate a good amount of free cash flow, invest once again into the business, and then once again redevelop your strong competitive advantage. It is a vicious circle and a very beautiful diagram to understand why there are certain companies which are giving you better returns than most of the companies. Then most of us in our MBA days have studied Ansoff matrix, and he has beautifully discussed Ansoff matrix with respect to investing. We never thought that probably this Ansoff matrix we learned in probably Kotler's book would be very useful for investing. He says that whenever you are entering into existing market, what kind of strategy you should have. If you're going to a new product in your existing market, what kind of strategy you should have. So very good example of Ansoff matrix and very beautifully described in this book. Next, he said, when to buy. When to buy is a very difficult thing that people think that they will be able to time the market. John Bogle says that in last 50 years of business, he has not seen anybody who has done this thing successfully. But that probably I know when market are going to crash, I know when market is going to rise, and I will be investing then only. He says that over a period of say 30-40 years, if your business is giving you 6% return only, irrespective of when you entered, over a long period of time, it would be giving you that return only. If a company A gives you 10% returns year on year for 40 years, irrespective you enter in low or high, you will be having for next 40 years 10% return. Similarly, if a company is giving you 18% return, 20% return, irrespective of whenever you entered, you would be having similar results in your investing when you invest in certain companies. So they are the certain checklists that Maslow has given for accounting ratio, governance checks, Probably you can go and look into the book as well. You should go into the book and you can check what are the key accounting ratios when you where you should look while investing into a company. See, for example, if I want to invest into stocks, maximum stock probably I should be holding is 15 to 20. So for those 15 to 20 stocks, I should be looking at certain accounting ratios. Which are those accounting ratios? The checklist gives you that. What are the governance check you should have? What are the forensic checks on the banks and NBFC you should be having? Right? Say we say that there are couple of industries which are there into nascent stage. Say SDFC, AMC. For talking about AMC, only probably 2 or 3% of Indian population are investing into mutual fund. Say for example, this ratio goes from 3 to only 20%, right? Most of the developed economies, almost 80, 90 or 100% of people are investing into mutual funds. Say this 3 goes to 20, 6 times. So for a stronger company like SDFC, AMC, only sky is the barrier. Look at the amount of growth you would be having, right? So if you want to invest into AMCs or probably banks and NBFCs, what are the key sectors, key ratios that you should be looking for? Look for those ratios and then invest into those companies. What are the competitive advantage you should be checking, whether the company is having any competitive advantage of innovation or brand or an asset. Are they doing their capital allocation right? Forget about timing and pricing, I think, for the consistent compounders. So basic checklist is sales growth every year of 10%, not like a company in 2010 books at 20%, next year 0, 20% 0. Those are kind of company we should avoid. It is like every year you're crossing a hurdle of 10%, right? ROCE of 15%. Why ROCE of 15%? Say if I'm investing in a company for 10 years, it should be at least be risk-free premium plus the kind of premium I am expecting while investing into equity. Risk-free premium is a 10-year return that probably a government bond would be giving me as of now is close to 6.2, right? So 6.2 plus almost my risk premium, which should be close to 6-7%. So it becomes 13%. So basic return that I should be expecting out of equity is risk-free premium plus the kind of premium I am expecting by investing into equity. 15% is a basic number. So your company should be giving me 15% year on year for last 10 years. That is when probably I can consider you a consistent compounder. And if you're going towards banking an NBFC, ROCE is probably not considered. You should be looking at credit growth. What is the business of bank? I take money from you, I lend it to different people. So if I'm not lending growing my lending book by 15%, I'm not doing justice to the money that I am acquiring, because I'm also paying you interest on that. So these are the certain kind of checklists that you should have. This is a very, very beautiful book. Probably you should be purchasing. And probably this is a very big video from me, a big moment from me rather, for doing this review. I'm not entirely capable as Mr. Saurabh Mukherjea is, but then I think you should go and buy this book. It will be giving you a lot of insights for purchasing the stock.